Hi friends, let's begin with our next lesson, which is project finance of our financial management. Okay, now project finance, it is purely a theoretical chapter. There are no sums, which it's not there. There are no sums at all in this chapter. They are just talking about that if a project has to be financed, what are its different methods and how a project report is prepared. Okay, in order to analyze whether that project can be financed by a bank or any other financial institution, or what are the tax benefits which we get on that, or any other external foreign loan or something like that, which can be taken to project that particular or finance that particular project. Now here when I talk about a project, we are talking about long-term infrastructural, industrial and public service related projects, okay, like bridges, highways, pipelines, power plants, oil fields, etc. Okay, so whether this financing has to be done through debt or equity or mixture, okay, whoever is doing this particular project, okay, the risk in the project will determine whether it has to be amount of a loan or equity. Greater the risk, then yes, obviously it will be an equity component. Cash flow from the project, it is very important in order to know that how we will do the repayment of the loan. And project finance may be with or without a recourse, means if there is a there is a default, whether the bank can come back to you or not come back, with or without recourse. We will see that later when we will see the other ways of financing this project. Now if I want to have a project finance steps, so if I want to finance a particular project, I will first see the feasibility study of that particular project, then project planning, project report, appraisal of the project, then definitive agreement, means the loan agreement, etc. Then disbursable of the funds, amount of the loan, and utilization reports to the banks, investors. This will be the steps in project financing. Okay. So first, starting with the feasibility study. Feasibility study. Now what is this? So the project is first primary step is to understand this particular project from its market, technical and financial feasibility points, whether it is feasible in order to take up this particular project. So market feasibility, technical and financial feasibility are very important to be studied. Okay. So now what is market feasibility? Whether there is a potential demand and supply for that particular product and service, or whatever you are going to take up within or outside the country. Forecasting made on that basis. Then technical feasibility. Okay, the technology, alternatives, resources, raw materials, product mix, what is all going to be used, okay, technically for this particular project. And financial feasibility, whether this particular project, the amount of input will generate your output, the return, the repayment schedule, etc., the risk analysis, everything. Okay, that is your feasibility study. Next is your project planning, number 2. So basically, what is your project planning? Once you have understood the feasibility criteria, all the 3, the next stage is your project planning stage will begin. Okay, so here you will define all your project activities and your end products that will be performed, and describe how you are going to accomplish these activities. So basically you will have all your activities and goals mentioned in this project planning. Okay, the specific work to be performed, goals that define and bind the project, estimates to be documented for planning, tracking and controlling the project, commitments that are planned, documented, agreed to affected groups, and project alternatives, assumptions, constraints, everything will be given in this particular stage. Now, importance of project planning, it is an approved document. It is a project plan is a formal and approved document. It is used by the management, and there is a control which is kept on that project with the help of this particular plan. So that is also project planning. Project plan is a very, very important document used to manage and control a project. Okay, so we have done project feasibility, project planning is done. Then we will be going to the project report. However, importance of a project planning and steps in project planning process will be what if you're making a plan, okay, on the following basis. First, define the technical approach which you are going to use to solve the problem. Then the tasks which are to be performed. Identify all the tasks and the activities. Define the dependency relationship between the tasks. Estimate the resources which you will require, the schedule to perform the task, budget for performing the task, define the organization used to execute the projects, identify the known risk, all the entire research development thing is there. Define the process used for ensuring the quality, define the process used for specifying and controlling requirements. Okay. So evolving plan of a project, strategic planning, it is a long-term planning, business needs, budgets, IT strategy, resources, concept definition, okay, project categorization, your organization, cost constraints, everything is make or buy decision is coming in concept definition. So 1, 2nd, 3rd, planning, risk identification, okay. Then you have, once you have done that, you start with your project, then perform the project and project is closed. Okay, so these are the 5 headings which you can just read through, nothing much. Then project appraisal. Project appraisal by financial institutions. Now you want to finance this particular project. So obviously the financial institutions are not going to grant you the finance like that only. Okay, so project report here. Okay, your project report is submitted by a corporate unit to a financial institution for the grant of the financial facilities. Now, project appraisal is done as a business risk, okay, and therefore efforts are made to corroborate the data submitted by the company with authentic sources. So, when I used to work, in Citibank, we used to work in case of business lending. I was in a business lending department and we used to provide loans to corporates, okay. So when loans are provided to the corporates for some particular project, okay, they are coming up with say a Kalpataru is coming up with a particular project, or there are certain companies which are having a huge amount of investments where a lot of research and identification. It's a new project, okay. Generally loans are not given to any kind of a new emerging business, about all that. Banks really do not provide loan to them. But when it is a project which is done by a well-known corporate unit, everything is studied. That business risk is studied by the banks, okay. There are all professionals who are hired to understand the risk, how much return will be generated by the risk. A report is properly prepared, which used to run into like 50-100 pages, along with their projected balance sheet, projected financial statements, projected profits, etc. Okay, so all this is prepared and submitted to the financial institution, and appraisal is done based on that. So each project is appraised on its own merits, and flexibility is observed while applying the norms like ratio, fund flow, cash flow, etc. Okay. Then viewing the above angle, like if you are doing the appraisal, basically what are the criteria, or what are the things which a financial institution generally consider. So they consider the profile of the project, its reliable and formulation and the project report. Then how much is the promoter's capacity and competence to complete that particular project, and the validity test or viability test from your technical aspect, financial, economic, your societal aspect, distributive, environment aspect, organizational, commercial, marketing aspects. Okay, all this is being seen by the financial institution before providing the loan. So first, obviously, they will see the first and foremost consideration they will do for the appraisal of project report by financial institution is to examine the report itself. So first thing they ask about the report only, with other relevant documents, etc. It may be recalled that the term lending financial institutions have established by the government with the sole objective to promote development and growth of the industries which are given planned priorities for economic development of the country. Obviously, because these are for the societal's benefit, no? So obviously the financial institutions, they give them the priority when they have to fund these type of projects. Okay, another important consideration which they do in the project report prepared, they should be confirmed prescribed standard of the financial institutions. Okay, they have to be like, there are certain eligibility criteria which each financial institution sets. Even in our Citibank we had that we had to first find out whether this particular, if we have received some balance sheet P&L of a particular organization, whether they are eligible for the loan or no, and if eligible, then how much, for how many period. Each financial institution have their own standards and norms based on the standards set by RBI of course, and then they keep changing based on that. Okay, then how much is the interest rate, etc. So project report is the first thing which the institutions check. Then comes the promoter's capacity and competency. Even for promoter who is going to actually, he is the one who is going to give work on that particular project. So he has to be competent, he has to be in the capacity to complete it. Okay, his background, his entrepreneurship, whatever, his integrity, reputation, everything is taken into account. Then viability test. Okay, different viability tests. First one is the technical aspect of the project report. Okay, now project appraisal's technical process and its suitability in Indian conditions. Okay, so technically all that is seen. So technical feasibility is generally examined. They call for the technical specialist, okay, of that organization. Bank seeks opinion for the project appraised through experts like consultants or organization like that technical consultancy organization. Then financial aspects of the project appraisal. This is the most important for a banker. Okay, because the primary aim of the financial analysis is to determine that the project satisfies investment criteria. If the amount of money is going to get invested, bank has to take it back, no, with the principal and the interest amount. So is it financially feasible? It is acceptable to take it up or no? The project should be able to service the debt and ensure expected returns to the investors. Next is your economic appraisal. Okay, from the entire economy point of view, determine whether the project will improve the economic welfare of the country. Okay, economic appraisal is traditionally not conducted in the banks or financial institution. It is conducted by the agencies like World Bank and development agencies of that government. Social and distributive appraisal, again same thing, we're talking about the society. Okay, so in order to be complete, it should not only be for financial economic point of view but also from the social appraisal. Okay, so it has to measure the distribution of income due to the project, amount of employment you are going to generate, income which are going to be distributed, and identification of its impact on basic need objectives of the society. Okay, then environmental aspect. If you are coming up with any kind of a project which is going to have an adverse effect on the environment, there again it is going to be a problem, because now even in India we have all environmental impact projects, reports to be prepared, submitted. Company secretaries are the ones who kind of give a consent to those reports whether this project is not going to harm the environment. Okay, so environmental concerns into their project formulation and appraisal is also now taken into consideration. Okay, so now these banks and financial institutions, they insist on environment impact assessment to be done, EIA. Okay, that assessment is like an audit. They conduct an audit, environmental assessment audit is conducted, and then this particular project report is given that this project is not going to harm the environment. It is they consider all the environment risks which are there, which can be combated by the organization, okay, and addressed by them. Organizational and managerial aspects. The managerial capacity, there should not be any kind of a deadlock in the management in the organization, otherwise the project is never going to get completed. Okay, so even if you will see certain banks and all, they keep these the ones who are into real estate business, you will find them into negative list. They will generally not provide so much of loan to them. Okay, because there is always a deadlock in kind of this real estate. I'm not talking about real estates like Lodha, etc., but any new emerging person in real estates, no, banks will never be able to provide them loan. I'm not talking from society benefit. I'm talking on their one-to-one project. Okay, so why is that? Because there is a lot of deadlock. There is a change in management which keeps happening. Then there are there is a problem in our taking all the approvals from the government keeps changing, so that is why these type of certain industries are under a negative list when it comes to bank finance. Then commercial aspects, including the marketing, that if a project is including, there is arrangement for supply of inputs, and similarly there has to be a supply of outputs in a timely manner. Okay, so all these aspects are taken into consideration. Then the next is lending policies and appraisal norms by the banks and financial institutions. Again, this is the same, you all can just read it. Okay, a lot of deposits are taken from the public by banks, and then based on that deposits only these loans are being taken. So basically it is public's money. So bank has to be very cautious. They have to see the safety, liquidity, profitability and the risk diversion when they provide any kind of lending to these organizations who are doing this project. Okay, there is a loan agreement, which is the next step. After you have studied everything, you do a loan agreement with the financial institution, which is expressed in writing, okay, between the borrower and the lender. Okay, and if there are any other creditors also involved in syndicate banking, means one bank cannot fund the entire project. So 2-3 banks together, they come in a relationship and they fund that particular project. So everything has to be as per the loan agreement, everything written down. Next will be your project review and control. Keep on reviewing the project till the entire project life. Okay, monitor it, evaluate and try to control. Okay, the bank, when they provide certain times those financial institutions who provide huge amount of loan to a company, they will make one of the directors sit on the board, independent director, who will be nominated by this particular financial institution, so that they are well aware that okay, this particular money is used in this project. Monitoring is becoming easy. They can evaluate on timely basis, and if there is a project control, which will stay in their hand. Okay, so project monitoring. Okay, what is project monitoring? Project progress monitoring. Okay, we have to see the progress. Project has started, but whether it has started and moving ahead or not. So that is important. It answers question like, have the activities been completed as which has been planned? Have outputs been produced as been anticipated? So it is very important to know that the project report is in a progressing manner. Monitor that. Okay, so what will you monitor? A continuous review of the project progress. So its activities and output levels. Why? So that you can analyze the current situation, identify if there is any problems, find the solutions, keep the project activities on the schedule and have the proper outputs. Okay, and make decisions about human, financial and material resources. When this particular monitoring should be done continuous basis, and how? You can have field visits, reports. Project evaluation. It is evaluating means it focuses on the higher level of the means to evaluate how whether it is successful in achieving your outcome, whether it is successful in giving you that much of return, and it is able to achieve the goal finally, ultimate goal. So evaluation data is collected and analyzed less frequently and often requires a more formal intervention, often by technical. So you want to evaluate the project, it is done very less frequently, not very often. They keep on evaluating with the help of the technical advisors and external evaluators. Okay, and then the third one was project control. It involves, this was second, and project monitoring is the first. So monitoring, evaluation and control. And control involves establishing system and decision making process to manage variance between the plan and actual work done. Okay, so if there is a variance in the cost, in the time, in the schedule, in the scope, that variance should not be more. Okay, so if you have established a standard, you have to be according to that standard. That is how you will be able to control a particular project. Next topic is social cost benefit analysis, SCBA, of the project. Okay, it is a systematic and cohesive method to survey all the impacts caused by a project. Okay, so not only financial effects like investment costs, direct benefits like tax and fees, but also social effects like pollution, safety, indirect labor, market, legal aspects, everything. Okay, so it is to attach a price as to many effects as possible in order to uniformly weigh the above mentioned heterogeneous effects. So it is not only considering the financial effects but also the social effects in order to generate the benefit. Okay. Now what happens here is, when you study a particular project with the help of social cost benefit analysis, it will enable the investors to compare different project alternatives. Okay, hence these alternatives will not just be compared intrinsically but will also set against the null alternative hypothesis. Okay, the most likely scenario development in case project will not be executed. So when the investors have a choice in which project to put their money, they will obviously try to calculate this cost benefit analysis, and based on that they will take the decision whether huge amount, less amount, how much investment, okay, has to be done. Then you have lease finance. Now what is lease? Lease is like, you are providing, there is an arrangement, there is a contract between the two people. One is the lessor who grants the lease to the lessee, okay, and it is in exchange of the rental payments, the lease amount. Okay, so you can lease lands, buildings, and these are like for 100 years, 99 years, 50 years. Okay, so lease is where a particular lessee can then now use that particular property for that work on which he wants to perform. Okay, so there is a financial lease and there is an operating lease. Now financial lease is also known as a capital lease. It is essentially a form of borrowing. It is a borrowing. So it is an intermediate term to a long term non-cancellable arrangement. During the lease period referred to as primary lease period, which is usually 3 years or 5 years or 8 years, the lease cannot be cancelled during the primary years, whichever is set up. The lease is more or less fully amortized during the primary lease period. Fully amortized means written off. This means that the lessor recovers through the lease rentals his investment in that particular equipment along with the rate of return. Thus, finance lease transfers substantially all the risk and rewards incident to the ownership to the lessee, because the lessor has already recovered all his entire investment. So your lessee is only responsible for maintenance, insurance, and tax, etc. In leave and license, it is different. Leave and license, you just pay the rent. Maintenance, tax, property, water, etc. is all done by the actual owner. Okay, the tenant only pays the rent, but in lease it is not like that. In lease there is a huge, firstly it is for a very long term, 3, 5, 8 years, but generally you will see lease for 50 years and 100 years in case of land and all. Okay, in that everything is done by the lessee, because in the first some years only, in the primary years of the lease, the entire payment is given to the lessor in such a manner that he has already recovered his entire investment with the return. Operating lease is defined as a lease. Any other lease which is not a financial lease is a operating lease. Okay, so lease term is the lease term is less than the economic life of the equipment. So you can take a equipment or a machine on a lease. Okay, the lessee enjoys the right to terminate the lease at a shorter notice without any particular penalty or etc. Then hire purchase is another way wherein you can, hire purchase is a type of a loan which in initial years it is in the form of a hire wherein you pay some rent. So say for example a car, okay, vehicles, I have taken it on hire. Initially whenever I am hiring, I am paying the rent. Okay, and then later on with the payment of the last hire amount or the last rent, it is in the form of purchase of that particular equipment. So I used the plant and machinery on hire basis for some years, and then I finished making the payment in such a manner that the last installment was a full and final payment of the purchase amount. Okay, so here hire purchase is a loan or a contract that involves initial deposits linked to a specific purchase, okay, which is a way of obtaining the use of an asset before payment is completed. So you can use the asset and you are still paying. The payment of the hire purchase on monthly installment plus interest with the end of the agreement. Okay, so the main features are, there is a hiree, okay, like who purchases the assets and gives it on the hire to the hirer. Okay, so they purchase an asset and then they give it, okay, to the counterpart, which is the lessee. So here the lessor has purchased the asset, okay, and then now he is given on a hire to the hiree, who is the lessee. The hirer pays regular hire purchase installment over a period of time. These installment cover obviously principal plus interest. So principal plus interest amount. When the hirer pays the last installment, the title of the asset is transferred from the hiree to the hirer. Okay, whoever has taken it on the hire. So say I had taken a car on the hire. Okay, a particular equipment on a hire. I kept paying the installments. On the payment of the last installment, I was using the car until I was paying the installments, and then payment of last installment that belonged to me, the hirer. Okay, the hiree charges the interest on flat basis. This means that the certain rate of interest, usually 8%, etc., can be done. It is also mutual understanding when it comes to hire purchase agreement. Okay, then leasing and hire purchase, how it is distinguished, this you can read. Venture capital. Venture capital is a source of financing for new businesses, venture business. Okay, it is a venture capital funds pool investors' cash together. Okay, so small money from all the investors. Okay, so you pool it, you make it a pool and loan it to start up the firms and small businesses. So say I am a venture capitalist, I am a venture capital firm. Okay, what is my basic work? I provide them loan. I provide loan to small startups. Okay, small businesses, SME, or to startups. So from where will I get money? So I approach investors, I pool their money together over here. Okay, and I use this money for investing, and whatever return I get from here, I share it to my investors. Okay, this is what is a venture capital. There is a committed share capital. So venture capital prefers to invest in entrepreneurial businesses. Okay, this does not necessarily mean small or new, rather it is more about investments, aspirations and potential for growth rather than the current size. So even the size is not seen. They are more, venture capital are more interested in new type of businesses, something which is very unique, wherein they will be able to put the loan. So venture capitalists are those who will take money from the investors, tell them that you will get this much of return, and that they provide it as a loan to the new or the entrepreneurs, etc. Okay. Private equity, obviously it is privately, you are issuing shares to some set of people. Okay, so private equity is essential, a way to invest in some assets that is in publicly traded, or to invest in publicly traded asset with intention to taking it private. Okay, so unlike stocks, etc., private equity funds usually invest in more illiquid assets, that is companies. Okay, so private equity is also one way of financing your project. Then deferred payment agreements. Okay, this is also one way of source of finance to the industry. So machine suppliers in India or overseas where machinery is proposed to be imported may agree to accept payment in a scheduled manner, in installment manner, in the period which is ahead of the delivery. So you have taken the delivery and then the payment is made. So there is already an agreement for this particular deferred payment agreements. Okay, so delivery is taken, payment is done in a deferred manner, late manner. Okay, so so sometimes you have this you take a letter of credit, bank guarantee, all this deferred payments are offered by all India institutions. Then you have IDBI, ICICI for foreign machinery supply. So this is generally used for a foreign supplied machinery when it comes to India. Okay, then international finance and syndication of loans. This is also another method. Okay, international finance. Okay, generally when you take finance from international market, the rate of interest is little low. Okay, plays a very important role because the cost of capital reduces somehow, when you take international finance. And syndicating loans means from 2-3 banks together, there is an agreement together and they have syndicated a loan, so the interest rate also comes down. Okay, so in international financial market, the borrower from one country may seek lenders in the other countries in specific currency. So if say I have taken a particular machine from France, Europe, okay, and I have to make the payment also in the euro. So I particularly take a loan from there only and make the payment there and there only. Okay, so euro currency market, you have export credit which is available, international bond market, all these, there are a lot of banks, etc., and international financial institutions who provide you with loans, credit, LIC, letter of credit, bank guarantee. So here you can generate your finance through international markets also. So next is syndication. Okay, large sums are arranged without delay and there is a less cost. Whenever there is syndication, where 2 or more banks are coming together, okay, so the large amount will also be arranged, the cost will also be less. Gets better introduction to enter into international loan market without much difficulty. Funds are easily made available. The borrower is allowed to select the length of rollover period and choosing different currencies to repay and cancel agreements. So all this is done if there is a syndicate banking. And from the lender point of view, it helps the bank to share this credit. Different size banks can participate and they can also earn. It provides more profitability to the bank as the costs are low. Syndicated loan is an underwritten by small group banks which resell the portion. So it is an underwritten type of a loan also. Last is your corporate taxation and its impact on corporate financing. Okay, now corporate finance is also one manner in which projects can be financed. Okay, so corporate finance is a field of finance dealing with financial decision that business enterprises make and the tool and analyst to make the decisions. There are 3 methods used in corporate financing. These are borrowings, either issue of shares, and retained earnings. Okay, so corporate taxation plays a very important role when there is a corporate finance which is involved. Okay, so capital gain tax, capital investment decisions, etc. obviously has, and when you pay interest, there is a benefit of tax again due to the payment of interest, due to which your cost of capital also comes low. This all we have studied in the sums. Then tax incentives for SEZ, small special economic zones, have been set up throughout the country in order to promote competitive business environment. Both the developers and the occupiers of SEZs enjoy substantial long-term tax holidays, concessions, and that are worth exploring when they're establishing that operation in India. So obviously government provides you a lot of tax benefits for the years to come when you are setting up yourself in a SEZ. Tax incentives for startups. This is also there to strengthen the startup ecosystem in the country and provide them support. Indian government have started giving them several tax benefits under the national startup policy. So they include tax holidays for a period of 7 years when you begin your startup is incorporated, exemption from tax, long-term capital gain tax is exempted, set off, carry forward, etc. Everything is kind of exempted. As a form of further relief, the government also provides exemption from the angel investment tax. Okay, when you're taking fund, you're taking loan from, or funding is done by the angel investors or families and friends. Okay, domestic funds that are not registered as venture capital funds, or funds which are raised from venture capital firms set up for the purpose of backing such ventures, will not be taxed on their investments into a startup firm. So if the venture capitals or angel investment is done in the startup funds, those particular funds are not taxed. Okay, this is, just read all this. Tax incentives for new companies is of course there. It has always been there, and the government keeps on renewing these policies for new companies. Okay, so there is a tax concession given by our government. And financing cost escalation, it results in increase in the project cost for many reasons. Okay, cost is escalated, going up, delay in the implementation of the project, and inflationary pressure on the corporate purchasing power. Okay, inflation, etc. results in cost escalation. Financial cost escalation will depend on corporate arrangement as to how the project cost has originally been financed. So how it has been financed, that has to be seen. Okay, depending now, if you have kept a fluctuating loan interest, so obviously there will be a rise in the interest rate, as in how the delay will keep happening with the project. Firstly, financing cost escalation in case when the project is new and financed by owner's fund only. So in such case, raising of equity is costly, but issue of right shares to the existing holders could be planned and the cost can be met out. Okay. Here there may be another situation when the company is existing company and the project cost is being financed by its internal funds, retained earnings. In this case, the company can capitalize its reserves by giving them and use amount of financing cost escalation, converting them into equity. Second situation, where the firm has borrowed sums in addition to equity capital for financing, then in that always make a request for additional funds to the lending institutions so that they can meet the cost escalation, okay, for that particular project. So this is it for your project finance lesson. Okay, go through it. All the importance, very simple. There is nothing which you have to sit and learn. So it is very easy also. So these are the basic, project finance, feasibility, project planning report, and the lending norms, and the way you can fund a particular project. Okay, your hire purchase, lease, then private equity, all the types of financing, tax benefits, everything. Okay, external borrowing, all that is important. Okay, you all have any doubt? You all want to ask me anything?
No, ma'am.
Oh, okay, fine. Thank you everyone. Bye bye.
Ma'am, are you doing another lesson now?